Hello financial fans, welcome back to another stock analysis. Today we'll be covering Apple stock ticker AAPL. Apple Incorporated is a multinational technology company that designs, develops and sells consumer electronics, computer software and online services. The company is well known for its flagship products such as the iPhone, iPad and Macintosh computers, as well as its popular software applications like iTunes, Safari and iWork. Apple is also the creator of the Apple Watch, a popular smartwatch that is highly integrated with its other devices. In addition to its hardware and software products, Apple also provides a range of online services such as the App Store, Apple Music and iCloud, which allows users to store and share data across their devices. The company's mission is to provide innovative products and services that enrich the lives of its customers, and it is recognized as a leader in design and user experience. Apple is a publicly traded company and has a global presence with retail stores in many countries around the world. They currently are sitting at a $2.5 trillion market cap, and their revenue in 2022 was $394.3 billion. And they're currently sitting at a dividend yield of 0.59%, and they're the largest company on earth. 58% of their revenue is generated through the iPhone, 22% through services, 12% through wearables and accessories, and 8% from iPad. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health and the growth of the company, and we'll be using a standard margin of safety of 25% that can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% reduction, and bright green will mean a 10% reduction from a margin of safety. And when we're using 3 colors in a scale, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% reduction from a margin of safety. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT for Apple has gone up, going from $49 billion in 2013 to almost $120 billion in 2022. The average growth in EBIT during this period was 12.5% annually, which is a 5% reduction from a margin of safety. The margin has also gone up, going from 28.6% to 30.3% in 2022. The average margin growth was 0.99%, meaning no change in the margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up, going from 38 cents a share annually in 2012 to 92 cents a share annually in 2022. The average dividend growth was 9.3%, meaning a 5% reduction from a margin of safety. And the payout ratio is still standing at a very solid 15.5% payout ratio, meaning there is still a lot of room left for Apple to increase their dividends further. This is another 5% reduction from a margin of safety. The final two metrics that we'll be looking at are the debt to EBITDA and the return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. And for Apple, this is half a year, in this case a 55% debt to EBITDA ratio, meaning a 5% deduction from a margin of safety. And the return on invested capital is sitting at 13.1%, meaning another 5% deduction from a margin of safety. Looking very good so far for Apple. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Apple going from 2017 to 2021. The average growth in free cash flow annually during this period was 16.7%, and I'm projecting an expected growth rate of 10% over the next 10 years annually in free cash flow. And with this percentage, we can determine the future free cash flow for Apple and determine the terminal year valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This leaves us with a sum of free cash flow of $2.7 trillion. And to get our equity value, we have to add the cash and equivalents and subtract the debt, leaving us with a $2.64 trillion equity value. All the stuff to do to get a discounted cash flow price per share then is to divide it by the amount of shares outstanding, leaving us with a discounted cash flow price per share of $167, which is a 7.5% upside out of this model. The second model that we'll be using is Graham's revised valuation formula. In this model, we'll be looking at the earnings per share that Apple is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds. And we go by the theory that the PE of a company with no growth is always at 7. And taking all of these metrics in account, we get a fair value of $123.69, which is a 20.3% downside out of this. The third model that we'll be using is the multiple valuation. In this model, we'll be looking at similar companies to Apple, look at their stock price and their earnings per share. This way we can determine the average PE multiple in the industry, which in this case is 25.64. All that's left to do to get our fair value is to multiply by the earnings per share that Apple is generating, which in this case is $5.89 a share, leaving us with a fair value of $151.01, which is almost a 3% downside out of this model. The last model that we'll be using is the mean reversion theory. In this model we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. I import the dividend yield of the past 5 years, and the average yield during this period was 1.08%, and the current yield is 0.6%, meaning that it's currently overvalued on this metric. The average PE ratio of the past 5 years was 21.1, and the current PE ratio is 26.37. And also out of this metrics, it also is overvalued, seeing as the PE ratio is currently higher. The fair value out of this model then is $105.46, which is a 32% downside out of this model. Let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow. We have excluded the discounted dividend, since their dividend payments are insignificant to make an accurate valuation, and since the value of owning the stock does not come from dividends. We've also imported the Graham's valuation, multiple valuation, and the mean reversion theory prices per share, leaving us with an average of $136.79. Our margin of safety we've determined earlier using a standard margin of safety of 25%, deducting it by 5% for the debt to EBITDA, for the EBIT growth, for return on invested capital, for the dividend growth and the payout ratio, leaving us with no margin of safety at all. This means our fair value is the same as the average out of all of the models, which is $136.79, and with the current price of $155.33, we get almost a 12% downside. If there's any other dividend stocks or other stocks that you would like to see me cover on this channel, please let me know. And thanks for watching.